Hello, good morning. Today we try to see a new subject. This subject is the psychology of a stock. Now, a stock is not a person. He shouldn't be like having a psychology or feelings or something. But I use this word psychology in order to show the characteristics of a stock. So, stocks are like people. It means they are like people. Each stock has what we call a personality. Has a personality. Now, what is funny about this is that as you find people who are like calm, you find stocks that are calm. When they move, they are very, very slow stocks that most of the time you don't find them in the news. Okay? A lot of these stocks, you don't find them in the news. So what the investors they do, the investors, they are looking for this calm stocks that no one speaks about. Most of the time they are like $5, $15, $20 in this range. Sometimes more. But these stocks, when you see these calm stocks, they are calm, okay? We say calm. You see them like this. Going from, for example, $1, 5, 7, 8, 20, 30, 40. So these stocks, but this in years. So this is, for example, 1 year, year 2, 3, like this. Now people or investors who get these companies, who search for them, and they see that they are good bargain, what they do, they buy them when they are cheap. Okay? When they are cheap. Like, for example, companies. I will give you an example. For example, Google. Google, if you have bought Google before, like when it was like $10 or $15, like, or Apple, just an example, when it is 10 or 15 or something, and you see that it's going so fast, it's going like, at first it was slow, and then when the people know about these stocks, when they are very known, when they are big, when they are 200 or 300, and thus the people they can go and buy But typically Google and Apple, like these two examples, they are called growth stocks. But at first, the first thing, no one noticed them. But when they become big, a lot of advertisement, a lot of news, each day they speak about them, they speak about Google or Apple, and a lot of people, they buy them and they keep them for the long run, and this. But this is just an example. There are other stocks that are not known at all, like fashion stocks, fashion stocks, or any other thing that the people, they are not aware of, and the news, they don't talk about them until they become big stocks. Now when they become big, this is another story. Now here, when they say calm, I'm speaking about the stocks that go always slow and slow and slow, but their development is big. It means the increase in value is big through the years. Not for 1 day or 10 days or 16 days, no, but for the whole life of the stock. You see that the stock is calm. It doesn't go each day so much. Maybe 10 cents, 15 cents, 20 cents. But this, when you see 10 cents, 50 cents, some of the guys, they don't go at all to the stocks because it takes so long to have very, very large profit. So these most of the time are for investors who invest for the long run, or those people who work for the company. Okay, I will give you just an example. A company, for example, let's say Google or any other company, when the people or the workers who work in the company, they buy the stocks at first. It means when the stock or the company goes public. Okay, they buy the whole life buying, and if the stock begins with 10 and after 10 years it is 30, 10 years it is $30, so they have 200% of their money, which is, or 300% of the money. So this is a very, very good thing, but this is for the investors. Now some other stocks, when they are what you call young or new, just like the IPO, initial public offering. When they are just new, they go public. Okay. A lot of people, like especially workers, they buy a lot from this because they stay with the company for the whole life. Okay, it's not just someone who buys and sells after 1 month or 2 months or 1 year. No, these people buy for the long run. Either the company goes up and they become rich, or it goes down and they become poor. So this is the thing about the stocks. Now there are some. This is what we call calm stocks. Some stocks that are nervous. Have you seen this word? This adjective? Nervous. This is the opposite of the others. Today the stock is 20, tomorrow is 25, the other day is 24, and then the other time is 19, 16, and then it is like 18. It means this stock is going very, very nervous, and because we have, most of the time we have a lot of traders trading here. Some they short it, some they go long, some they short it. So this, you find these stocks are very, very nervous. Okay, and for day traders, for those who like more risk, they like these nervous stocks. They like them very much, because they give opportunity to have a lot of money. But if they lose a lot of money. So these are very, very risky. So each stock, if you go to each stock, you find a stock that's going like this through the years. A stock that's going like this, a stock that it goes like this and go down, like 10 becomes $1. This becomes 10, it becomes 40 through the years. And some, they go like this the whole life. They do nothing. They go here, they go down, they go here, they go down. So they don't have too much capital gain. But these kind of stocks, they give what you call dividend, like 5% or 3% or 10%. It means a lot of people, they buy this not because of the stock is going up, but because of the dividend. Some who are retired people, they buy a lot of these. For example, if a retired person has $300,000, he will go and buy all these kind of stocks with dividend, and each month he will get, for example, each month he gets $3,000, just an example, from dividend. Okay, he gets 3,000 each month. So he used this for an income. Okay, it's an income. It means he used this money that he has, all his savings, to have an income from it. So he's not interested that the stock, if it goes up and up more, it's very good. But he's not interested in the stock goes up or down a little bit, but what he's interested in is dividends. Okay? So now these stocks like this, most of the time the investors they like this. They like these stocks that are slow, but during the time, they think about the time, about years. So they are very, very patient. So they buy a stock for the long run. It's not for 1 month or 2 or 1 year. They tend it for the whole life, or 5 years, or 10 or 20 or 30, until they get a large profit, and then they sell if they want to. Now, some like these stocks that go up a little bit and go down, some they short it for the long run. These are big traders, and so it's in general. In general, this is what I am talking about: the psychology of the stock. All the stocks behave differently. Okay, they behave differently. Okay, so you will never. It's rare to find two stocks they do the same, except this when they are in the same sector. Okay, in the same sector, same. Sometimes you find the stocks doing the same thing. Although they have different price, they do the same thing. I will give you an example. In a stock that it is 20 and it is 10. Okay, just an example. Two stocks. Now this 10, it goes up, it goes to 21. This, it goes to 11 or 10 and 50 or 10 and 50 or 25. It means the day is up. The day is up. Now, the day is up, the day is up, the day here up, the day is up, and then day down here, day down, day down, day down. Okay? Since they are in the same sector, they follow each other. Why? Because the same people are here, the same traders, the same where people they buy a lot, they go up, and some they sell. It means they are having the same thing. This is typical. Most of the time you find them in one sector, and they are following each other. But they have not the same price. Okay, they are different. Just in the daily chart, you try to see those. They have the same thing. If you go to, for example, if you go to the Dow with the 30 stocks, blue chips, the 30 stocks, some of the stocks in this list or this index, they go together. A day up, a day up, day down. You find 10, 15, 30 having the same thing. The same thing. It means people who buy at the same time and they sell at the same time. There are some stocks that are exceptions here. Not all they do the same, but there are just some or few. They always are together. So if you want to trade, you should have ideas. You should follow these stocks and then buy them or sell them as you like. Okay, and This is what I mean by psychology of stock. It means the stocks, most of the stocks are different, and each one has his own personality, his own future. Some they are very successful stocks. Take an example of Apple or Google. Just this is just an example. They are successful. They go from $10 or $15. They go to 700. From $10 to $700. You see, how much money will you make in this? For example, 2002. For example, Google 2002, 2012. If you buy it of 10, you buy, for example, 100 shares. It's $1,000, and you multiply by 700 times. It's too much money. It's too much. It's too much money. 100 by 7. So we have 2, 1, 2, 3, 1, 2. You will have $700,000. Which is a very, very large money. And you can make the same for this. There are other stocks that, for example, you buy at 10, it goes to 40, and then it goes to 10 again after 5 or 6 years. So you have made no money. If you sold like when 30 or 40 is good, but if the stocks go down and you don't sell it in the right moment, it will go down and down until it goes to where it begins with. So you will have a problem with it, and this is in general. Like some they are successful, some are average or normal, some they are losers. So it's like a human being. Some they do successful things, some they don't do nothing in their life, just eat and sleep and work a little bit or no work at all. So, and some they are successful, they do a lot of things in their life, and they are famous, and this is it. So thank you very much for watching this video. If you have questions about this or comments, just ask. Thank you very much.